Hello everyone. For this project, our objective was to evaluate whether Sprouts Farmers Market should acquire natural grocers, and if so, what the most suitable financing structure would look like. We began by screening companies in the natural and organic grocer retail sector because the industry has been expanding steadily. Driven by consumer shifts toward health, transparency, and sustainable food sourcing. During our research, Sprouts and natural grocers stood out as a strong potential match. Sprouts is already a major player with a large national footprint, while natural grocers operates a more regional model with strict organic standards and a loyal customer base. These characteristics suggested a possible strategic and operational alignment, making the acquisition worth analyzing. So in today's presentation, we'll walk through the strategic rationale, valuation, financial impact, and final recommendation for the potential deal. To give a quick overview of the companies, Sprouts is currently the larger player in the space, with a market capitalization of around $8 billion and more than 400 stores across the US. The brand is known for fresh produce, private label offering, and cost-efficient operations, which allow it to compete effectively in the natural grocery space. Natural grocers is smaller, with a market capitalization of roughly $650 million and a footprint of about 166 stores, primarily in the Rocky Mountain and Midwest regions. What differentiates natural grocers is its strict organic ingredient standards, a focus on supplements, and an education-based customer model, which has created strong brand loyalty. When comparing the two, we see that both companies operate within the same product category and business model, meaning the deal would be a horizontal merger. Strategically, this creates an effective fit. Sprouts gains a regional expansion opportunity, while natural grocers benefit from scale, broader supply chain leverage, and operational efficiency. Because their geographies are complementary rather than overlapping, the acquisition could accelerate expansion without cannibalizing existing customers, while also unlocking synergy potential in procurement, logistics, and private label development.
Hello everyone. Today I will briefly introduce the structure, consideration, and permitting logic of this transaction. First of all, in terms of transaction type, this is a friendly horizontal merge and acquisition. The two sides will cooperate to unify product standards, supply chain, and corporate cultures, laying the foundation for the future integration. In terms of the payment and capital structure, we adopt the method of 20% cash and 80% stock. Cash comes from the company's internal funds and is supplemented by a moderate amount of new debt. At the same time, we will issue shares to NGVC's shareholders so that we can share the surging of the future. Finally, there are quotations and permits. The unaffected stock price of NGVC is $30, where our offer is $36.9, reflecting a 23% permit. This permit responsibly reflects our expectations of surging, and it is still a moderate level compared with typical mergers and acquisition. Thank you, everyone.
So here I'll cover the synergies and ESG benefits of this transaction. So for cost synergies, the combined company gains stronger procurement scale, leading to better supplier terms. We also expect logistics efficiencies from shared distribution and fuller truckloads, and overhead savings through consolidating finance, HR, IT, and other admin functions. On the revenue and financial side, Sprouts can leverage the NGVC geographic footprint for expansion. There's meaningful upside from cross-selling supplements, strict standard products, and private label. A unified loyalty and digital marketing system should support higher traffic and basket size. And with larger scale and steadier cash flows, the merged entity could benefit from a lower cost of capital. From an ESG perspective, a more efficient network reduces emission and waste. The combined scale strengthens our ability to enforce sustainable sourcing, and customers gain broader access to natural and organic products with transparent standards. Overall, these synergies enhance both financial performance and sustainability.
Based on discounted cash flow valuation, we construct multiple operating scenarios for acquirer and target. For the target company, we have constructed two scenarios, T1 and T2. T1 is a more conservative scenario, with free cash flow is initially negative and recovers slowly. T2 has positive free cash flow starting from 2025, with higher projected EBIT, aligning more closely with performance improvements and synergy expectations in the proposed acquisition. Therefore, we choose T2 as central base, choose A1 T2 as operating scenario. In order to make the selected operation scenario more reasonable, we compare A1 T2 with the alternative options of three other hypothetical combinations. It can be seen that A1 T2 combines a relatively conservative acquirer with a moderately optimistic target company, avoiding overly pessimistic A1 T1 and aggressive A2 scenarios. This generates a moderate range of equity value for the acquirer, not only incorporating conservative revenue and margin assumptions, but also taking synergies into account, making the overall assessment fairly reasonable. Then I'm going to introduce the model's financial details. In the linear graph, there is a steady increase in net earnings, EBITDA, and FCF. The combined entity demonstrates strong operating momentum over the 5-year horizon, in line with the synergy assumptions in scenario A1T2. Secondly, the linear graph above shows the pro forma EPS and CFPS steadily increasing throughout the period. The equity dilution rate over the first 3 years gradually will decrease from -48% to -21%. On the other hand, the cash flow accretion is positive throughout the focus period, with CFPS increasing. The model indicates that under scenario A1T2, the combined will achieve substantial earnings and cash flow expansion over the first 3 acquisition years. EPS dilution persists initially, but strong operating performance and synergy capture support long-term value creation. The transaction costs are probably recognized in the model and don't affect the investment case.
From this slide, I will briefly highlight the main risks of the transaction. First, on the strategy and operational side, although both firms are in natural and organic grocery, their formats and cultures are different. Natural Grocers has a strong family-style culture, strict product standard, and an education-focused model. If Sprouts integrates too aggressively, for example by standardizing formats or relaxing standards to cut costs, it could damage Natural Grocers brand and push loyal customers away. A lot of our expected synergy depends on smooth integration, especially in procurement, logistic, and back office functions. So any delay or cultural clash could reduce the benefit. Second, there are financial and regulatory risks. The 20% cash and 80% stock structure limits the leverage, but it does mean meaningful share issuance and short-term EPS dilution, which equity investor may react negatively to even though cash flow per share improves. On top of that, the local antitrust scrutiny in overlapping markets and macro factors like weaker consumer spending or higher rates could both put pressure on the free cash flow and synergy case we have modeled. To sum up with our central A1T2 scenario, we see the deal as strategically attractive and financially reasonable. On valuation, we tested several combinations of assumption. Very low conservative assumption give a low value, and very aggressive ones produce unrealistically high values. A1T2 sits in the middle with a balanced equity value and an IRR around 12%, which view as realistic for this sector. And we propose a 23% takeover premium and a 20% cash and 80% stock mix. Compared with recent retail deals such as Amazon with Whole Foods or Kroger with Roundy's, this premium is moderate and should be attractive to Natural Grocers shareholders, while the mix keeps Sprouts leverage under control and lets Natural Grocers shareholder participate in the future of the combined company. Overall, our recommendation is that the Sprouts should proceed with a friendly acquisition of Natural Grocers using this structure, but with two clear conditions. First, to preserve Natural Grocers brand reputation as street standards, and second, manage integration and synergy delivery in a disciplined and smooth way. If these are done, the transaction should enhance long-term shareholder value despite the short-term EPS dilution. So this is the end, and thank you for paying attention to our M&A proposal with Sprouts Farmers and Natural Grocers.